Hey, good morning. This is Mayor Valensky with Driving Markets. Okay, so let's have a quick recap of what happened on Friday. So Friday, the markets dropped significantly. You had the Dow down over 930 points. You had the Nasdaq down with a whopping 500 odd points drop. And the S&P was down over 80 points on the back of interest rate fears. You've got major interest rate fears in the marketplace, and those interest rate fears are driving investors to run for cover. They're literally escaping from investments as fast as they can. Why? Because inflation is well above what it should be. The central banks are well behind the curve. They're so far behind the curve that even if they raise rates every month by 50 basis points till the end of the year, it's still not going to solve inflation. Why is that? Because inflation is running on a supply-based model. In other words, the supply chain has been broken for so long that there is huge demand for products and there's no supply. That was the basis of inflation. However, you would add on to that all of the liquidity and all of the easing of monetary restraints and the stimulus that the Fed and the central banks have poured into the economy through the corona period, and that together is an ingredient with the supply chain issues and with stimulus. You're going to have an underlying fairness of inflation, which is what's happened globally across the world, from Canada, America, Europe, UK, Japan. You've got inflation, which is, I said many times, is out of control. The only way they're going to rein in inflation, and I'm not sure if this is the actual answer, but this is what I believe, is that they increase interest rates significantly and they let that supply chain go to maximum capacity. The problem is that China has a zero tolerance policy on COVID. So China is closing down Shanghai and all the major industrial cities which produce huge amounts of goods that the West needs, and therefore that supply chain is frustrated. It's just simply not happening. In addition to that, you've got the Fed, which has a $9 trillion balance sheet, and it has to rein that in. So it's going to withdraw, it's going to pull in $9 trillion of excess cash stimulus that's in the economy, and that's going to suck the life out of the economic recovery, and therefore we're aiming for one place only: recession. We are going into recession. The States has already reported a negative growth over the last quarter on GDP of 1.4%. One more quarter of negative growth, that is an official recession, and that will impact on Europe, which is on the brink of recession, and the UK, which is on the brink of recession. Therefore, what you do have is a problem. You've got the central banks are now going to raise interest rates. They're definitely going to raise interest rates. So they're going to raise interest rates, which is going to increase the cost of money to the consumer. So that's going to take money out of the economy. In addition to that, you've got the central banks, which are going to pull back the stimuluses. That's a double whammy. In addition to that, you've also got inflation. So it's costing more to live. So you've got three factors. You've got the stimulus package coming to an end and the central banks pulling the money out. You've got inflation running riot, and you've got rates that are going to go higher, and that's going to cost the consumer more money to live and to get through the month on his fixed salary. This is going to have a major impact on the economies. All those three things is going to drive us into a recession. And a recession means potentially lower corporate earnings, which is what happened in effect on Friday with Amazon, or Thursday, when Amazon reported the first quarterly loss since 2006. Amazon dropped on Friday 14%. That's a huge drop, because all the prices of the Nasdaq and the growth sector and the high tech is super inflated. Their earnings multiples are simply too high. Therefore, any disappointment whatsoever across the board, and those shares are going to be hammered. And that's what happened. Those shares, Amazon, went down significantly. Even Apple, that came out with pretty good results on Thursday, and they said they're going to increase their share purchase program. They couldn't withstand the assault on the financial markets, and those shares also dropped, including Tesla, including Twitter, obviously, including Google, including CRM, including Salesforce, including Facebook. All of the shares went down on the high-tech sector. The high-tech sector is going to be the biggest victim of the rate rise. You can see the Nasdaq, and I'm stating this again, the Nasdaq by the end of the year is going to be at 7,000. What impact will that have on cryptos? So cryptos will also trend downwards with the financial markets going down, because cryptos are a high risk investment. So Bitcoin next station is going to be $32,000. If it holds that, great, it might bounce up. If it doesn't, it's going all the way down to $25,000, and that will pull all the other cryptos down with it. So you've got to keep an eye on the cryptos, and that will also be a victim of a rising interest rate economy. What else do you have? Foreign exchange. As it happens on Friday, the dollar took a battering because of the confidence lost in the high-tech sector and the economy, and then the dollar did drop significantly. However, going forward, expect the dollar to rise further on the back of interest rate rises. It will become a sought after currency. Therefore, you expect to see dollar strength throughout the rest of the year. Oil also fell back on fears of recession, so you've got that to look at. And the 10-year yield on the US Treasury jumped to 2.92%. In my opinion, the yield is going to surpass 3% very, very quickly, and that will make investors even more nervous when they are at wherever they are at the moment. So generally, the trend is down. I've been saying this since January. The trend is down. You're going to have markets that are very volatile. The VIX, which is one of the measures of volatility, is up at 33, which is well above the stability level of 25. And that is indicating extreme volatility in markets. So you're going to have volatility in cryptos, volatility in foreign exchange, volatility in shares, a sinking high-tech market, a sinking Nasdaq market, all because of inflation and interest rate fears. So you can catch me on LinkedIn, on YouTube, on Instagram, on WhatsApp, on Twitter, in any other type of media platform, whatever there is. Mayor Valensky, Driving Markets. Have a good day.